Today we're going to go through an example of how a gamma squeeze could transpire, and I think the best way to do that is to go through an actual example. We picked CCIV because there are a significant number of option contracts which are expiring next week on Friday, March 19th, and today it's March 14th. In the past couple of weeks there's been little activity in terms of call options. Now, just to give you a little bit of a background, CCIV, it's a SPAC, which is a special purpose acquisition company. Recently, they made an announcement to merge with Lucid Motors, which is an original equipment manufacturer of electrical vehicles, EVs. This is not a fundamental analysis because EV market right now, it's relatively hot, but there are multiple OEMs that are tapping into the same space, and they are transitioning from internal combustion engines into the electrical vehicle space. So from a market share perspective, it's difficult to predict. This is a pre-revenue company, Lucid. So it's relatively difficult to make an assumption as to where the stock would end up. And again, this is just a SPAC, so the SPAC would only own a smaller portion or a small portion, less than 20% of the combined entity or the merged entity post-acquisition. So the announcement happened recently, but today we're just going to go through the options which are outstanding, the open interest on those options coming in due on March 19th. So what is a gamma squeeze? So gamma squeeze, it's when the market makers start hedging, and typically when the stock is going down and they have a significant number of open interest on call options out there, then the market makers don't necessarily need to hedge. And as the stock reverses and it's moving up, then at some point they need to make the consideration of whether or not they need to hedge against the possibility that the stock or those contracts would end up in the money at the expiration date. So in general, this is somewhat amortized, meaning that there is some cushion around, and eventually a gamma squeeze is difficult to predict. But one indicator is when you see a significant number of outstanding call option contracts which are coming in due, and they are unusual compared to what you've seen in the past, and that call to put ratio is also high. Now, the reason why the call to put ratio is high in this case is because the PIPE investors, which are the private investors, public equity firms that came in at a stock price of $15. Now, CCIV, it's below 30 right now, but at some point it was all the way up to 60 some dollars. And this was pre-announcement, so there was a lot of hype around this stock pre-announcement, but then once the announcement came in, the valuation details came to light, there was a sell-off, right? So there was a buying the rumor and selling the actual news. So that's what happened. Now, right before the announcement, there were no weekly options on this stock. And then post-announcement, the weekly options started coming in. And you can see that the last 2 weeks, the number of outstanding or the open interest on those call options in terms of the number of contracts was relatively small, from 7,200 and in terms of the contracts expiring on March the 5th to down to about less than 2,000 in terms of the contracts expiring on March 12th. Now, because the monthly, which is the one which are the contracts which are expiring on March 19th, existed before the announcement, there was significant interest in terms of this stock. So there were a lot of contracts which opened prior to the announcement. Now, those contracts are coming in due on March 19th. So what are the underlyings right now that we have in front of us, right? So, and these numbers might have changed a little bit. I think I checked a few, and it was relatively the same, but some contracts got closed as of last Friday. It's March 14th right now. So right now, starting at strike price of 35, we have significant number of open contracts in terms of call options, starting with 25,000 call options at the strike price of 35, and then you can see the strike price of 95 at 16,000 call options out there. Now, if you look at the last 2 weeks on the weeklies, there was nearly nothing past the strike price of 36. So what does this mean? Well, come March 19th, you have 191,000 open call option contracts. And as you know, there are 100 contracts, or there are 100 options in each contract, so this represents about 20 million shares. Now, there are about 200 million shares outstanding, and this is just I don't want to say a ballpark figure, but it's more of a rounded figure because I didn't want to go into too much detail, but it's about 200 million shares outstanding. About 50% of it is represented by institutional investors that are not necessarily trading this in and out. And what is left, it's another 50%, which I want to call it the retail float, not necessarily because the float in itself is about 200 million, but the retail float, like what you and I can trade, it's about 90 some million shares. So the 20 million shares that are represented by the call option contracts expiring this coming Friday, they represent about 20% of the entire retail float, right? So that's a huge number. Like even if you go and search amongst the different stocks out there, and you look at these indicators, this metrics, these KPIs, I want to call them, a 20%, or a 20% representation by the open contracts coming in the next week, it's pretty high in terms of as a percentage of the retail float. And the other interesting thing is that last Friday, on March 12th, there were about 20 million shares traded that day, right? So the open interest that we have in terms of the call option expiring next week on March 19th is 20 million shares. It's nearly 100%. So there could be, if there is a catalyst between now and March 19th, then we could see a significant number, or we could see a significant number of the market makers trying to hedge against their positions just to make sure that they are traded. So they include in their balance sheet, like that stock, they need to buy the stock to kind of hedge themselves from the risk of the stock being in the money as you approach March 19th. So the stock price could go up. Now, how does this work? Let's go through an example. So in terms of the strike price of 35, let's take that as an example. The delta, it's stated at 0.12, right? And let's say that come Monday and Tuesday, the stock price starts moving up. So we know that the stock price, it's under 30 right now. And I know that in March 17, there is a tech event that Lucid will partake. And it is possible that they make some sort of innovation announcement or anything that they have to announce. They'll probably do it there. But this could be, it's tech related, but it could drive some additional buying and increased in volumes in terms of the traded shares that could result into increased volatility. And as the volatility goes up, and let's say that the stock price starts going up alongside with it, and we can see that we can see that the delta on the strike price of 35, let's say it goes from 0.12 to 0.62, right? So at the strike price of 35, there are 25,000, roughly about 25,000 option contracts coming in due by March 19th. And they represent about 2.5 million in shares. And before the delta going from, let's say, 0.12 to 0.62, let's say that the market makers decided to hedge against it just for that strike price, right? This is just an example. So they would have to buy about 12% of this 2.5 million shares represented, so that they are hedged against the possibility that they end up in the money. Because that 0.12 cents, the delta, that is another way that market makers look at it is in a percent, from a percent perspective, right? So 0.12, it's about 12%, and it means that there's a 12% likelihood that the stock will end up in the money by March 19th. So they decide to buy about, 300,000 shares? So out of the 2.5 million shares represented, about 300,000, they are hedged. So they have another 2.2 million. Now the delta starts moving up real quick because let's say that the event on March 17th creates an environment where there is some commotion around the possibility that this company has some great news coming up, or it could be a number of things, right? That this is completely hypothetical. We're not trying to make a prediction here. We're just trying to put an example out there. So let's say the delta goes from 0.12 to 0.62. So it moved by 50 cents in terms of actual delta, or the premium would go up as a dollar moves up in terms of the underlying stock. But it also means that there's another that the 62% chance it went from 0.12 cents to 0.62. So now you're looking at it as 62% chance that this ends up in the money. So they covered the first 12%. Now they need to cover an additional 50%, right, on the outstanding ones. Well, what's the outstanding or non-hedged? It's the 2.5 million less than 300 shares, so 200.2 million shares. So you take 50% hedging on that, then you have to basically the market makers have to buy 1.1 million. And the funny thing is that as they keep buying, the volatility will, or the volume will go up. The volatility on the underlying stock will start going up. And then the gamma, which is the slope beneath the delta, meaning that it will show the rate of change in the delta as the stock price goes up by $1. So it's basically the slope on the underlying delta. Would go up, and then the delta will start rising at a much faster increasing rate, because that's what the gamma means, right? It's the rate of increase or decrease in the delta. So if that rate goes up significantly, then you have more market makers going in and start buying to hedge because they cannot keep up, right? Like that's the squeeze. That is what the gamma squeeze in itself means. It's the rate of change in the delta starts moving up so high that they have to go in as fast as possible to hedge against their positions, right? So they put the stock in their balance sheet so that by March 19th they'll be covered, and essentially they are downsizing their risk. Now this is only one strike price. As you move on from the strike price of 35, then you go to 36, then you have 40, which you have another 28,000 contracts out there, then 45, then 50, then 55, then 60, right? So this creates an environment that this could turn into a snowball. Again, this is completely hypothetical right now, and it doesn't have to do anything with what could transpire next week, but the conditions are there that there are a significant number of outstanding option call option contracts that are coming due on March 19th. And there is also an event which coincides with this next week, which is on March 17th. So it's essentially a couple of days right before the expiration date on these contracts that could trigger some sort of an increase in the strike price, increased volatility. And as we see the volume, the underlying volume traded on those option contracts, it's good to keep an eye for an increase on that volume, right? So the open interest, it's one thing, but you also need to see what is the volume traded beneath, or what is the volume traded daily for these option contracts, for the open interest on these option contracts. So so that is what essentially could trigger. In this example, we kind of went through what CCIV, or we went through the underlyings behind CCIV and how a gamma squeeze could potentially transpire next week. And again, this is hypothetical. It's got nothing to do with the fundamentals beneath the Lucid, or in terms of Lucid itself and where Lucid would be in 5 years. Again, they are a pre-market, or they are a pre-revenue company. There's a ton of competition right now. A lot of OEMs are moving towards EV, so no one knows. But this week, though, like will mark a big week in terms of option contracts coming to an end, or at least coming due. And you can see from the past 3 weeks that the increase is substantial, right? That we're talking about going from 7,000 contracts, which is about 725,000 shares, to 19 million shares, right? 191,000 contracts. And so it's a good thing to keep an eye out for this, but it could be an arbitrage possibility. But again, there's not a whole lot that you can predict here. It's just like the circumstances have to be such that this could potentially trigger a gamma squeeze. So we'll keep an eye out next week just to see what happens. But hopefully you enjoyed the video, and feel free to subscribe, and then just come back again for the next video. Thanks. Bye.